The organizers asked me to prepare a few remarks regarding debt sustainability. Is there some magic number of, let's say, the debt to national income ratio beyond which it is not sustainable? There is no such magic number. The beauty and the ugliness of public finance is that it's very, very different to personal finance. Public debt never gets repaid. All you really need to look after is the sustainability. And the reason why personal and public finances are so very different is that there is a fundamental difference between your budgetary problems and the state's budgetary problem. And let me give you a very specific example. If tonight you refrain from going out to a fancy restaurant and you save 200 euros, your income will not have declined because you saved the 200 euros. So by tightening your belt during difficult times, when, for instance, you are facing a deficit in your personal finances, you shrink the deficit. So parsimony, saving, belt tightening, works at a personal level, at the level of the company. But in difficult times, when, as finance minister, you are experiencing a bulging and an increasing public debt, or public deficit, I should say, budget deficit, because the private sector is shrinking its expenditure. Private expenditure is coming down. If you try to apply belt tightening, that is austerity, at the level of public finances to cut spending, let's say, on health and education, pensions, on public investment primarily, what you're doing is you are accelerating the decline in national income, because private expenditure plus public expenditure, the sum is national income. So, and here is the important contrast. Unlike your personal situation where not going to the restaurant, reducing your spending, shrinks your deficit, if you are caught up in a recessionary environment or even a stagflationary environment, and you try to shrink the public deficit, the state deficit, by cutting spending, all you will end up doing is you will accelerate the reduction in national income and therefore your tax take. So you will look very soon like a silly cat chasing its own tail. So austerity never works. It only works if you're free riding on your trading partners. And then they will, of course, respond and retaliate. So austerity is even worse than tariffs in that sense. On the other hand, largesse doesn't work either. That is, printing huge quantities of money using the printing presses of your central bank, like it has happened in the West after 2009, when $35 trillion was minted as part of what's called quantitative easing in order to bail out the bankers. It doesn't work for two reasons. Firstly, if you bail out the bankers, not the banks, there's a difference between bailing out the banks and bailing out the bankers, right? So South Korea in 1998 didn't bail out the bankers, but it saved the banks. Sweden in 1992. But the West, the Anglo-European American West, in 2008 made this huge mistake of saving the bankers as well with money that was printed. That essentially is signaling to bankers, go crazy, go rip, produce as much credit as you can. That is effectively the foundation of the next financial bubble. And it doesn't work, especially if largesse, money printing, quantitative easing, if you combine it with austerity for the many. You have socialism for the bankers. This socialism, I mean this ironically, and austerity for the many. Because what happens then is this. If you are a financier, the central bank calls you and says, hundreds of millions are available to you to give away to big business. But if you are, let's say, the CEO of Volkswagen or of Siemens here in Germany, right? And your banker calls in the middle of this recessionary situation and says, I've got a few $100 million for you for free, interest free. You take it. But then you look outside your window and what you see is impecunious, austerity hit populations. and you think they will not be able to afford a very expensive, Tesla-like model by Volkswagen, so I'm not going to invest. But you take the money because it's interest-free. And what you do with this money? You buy real estate here in Berlin, asset prices go up. You buy your own shares. Volkswagen buys its Volkswagen shares in the Frankfurt Stock Exchange, so share prices go up. And the result is huge inequality, no investment. This is why Germany is deindustrializing as we speak, because the combination of austerity, which was meant to rein in the debt, plus largesse, money printing from the central bank for the financiers and big business, has combined to create inequality, which is the greatest gift to right-wing xenophobic populists, with stagnation and eventually Europe, Germany, as a result of this policy of using austerity in order to rein in debt, has missed a technological revolution. Now they can't compete with the Chinese or with the Americans in producing the technologies of the future, electric vehicles, batteries, and so on. And the result is that now they're asking us to buy tanks because they can't sell cars.
So quantitative easing and austerity, overly simplistic, don't work. Minister Babakan, what are some opening, big picture pointers that you'd like to share with us?
Well, good morning, everyone. Greetings from Ankara. Ladies and gentlemen, distinguished guests, it's a great privilege and honor for me to address such a distinguished audience, and I would like to express my sincere appreciation to the organizers of the forum for this high-profile and exciting event in Berlin. During this session, the topic is public debt, stability of the banks, and this is a subject which affected the whole world, especially in 2008 to 2009 global crisis. When we talk about economy and welfare of the citizens, the single most important concept that we need to concentrate on is confidence. Confidence is about telling truth. Confidence is about transparency. Confidence is about fulfilling the promises. It is about meeting obligations on time and in full. When governments face unsustainable debt burdens or when banks become unstable, confidence is down and the consequences are felt in everyday lives. I will start with the issue of national debt, which was at the core of the global crisis. Unsustainable government debt levels lead to two kinds of destiny. One, default, which in effect is the bankruptcy of the state, or two, austerity measures, which mean tightening the belts. The first one happens in an uncontrolled way, and the second happens in a slow but controlled way. But the results are not too different, maybe. Whichever happens, the result is higher unemployment, reduced level of government services, and diminishing access to essential health and education services. At the end of the day, it is the citizens who suffer from what happens. This is also how we lose lives during the crisis. Elected governments are always under enormous political pressure to spend. The motto is borrow it, spend it, enjoy it. Make people happy and collect the votes. Don't worry about the future. Unfortunately, that is what happens with most of the cases. So most of the time, one government borrows, spends, delivers, but the next government pays for it. But then there's a threshold of debt. So you borrow, spend, okay, but then the debt reaches to a certain threshold, which may differ from country to country, then the ability to pay it down becomes unlikely. And the level of debt is important, but the direction of the debt sustainability is also very, very important. The government needs to strike a balance between spending today versus paying for tomorrow. This balance is also about how much joy for today and how much pain for tomorrow. How to reach the balance, how to strike the balance between the two. Several points which I would like to highlight is, first, keep the budget deficit at a level which does not trigger a debt sustainability question. So budget deficit at the core of any fiscal policy. The second point is, spend the government money into investments in an efficient and effective way so that the spending propels growth. So it's not about just how much you spend, but where you spend it, which makes a difference. The third point is Be very transparent about fiscal affairs so that markets will not price in unnecessary risks. Transparency also brings early warning mechanisms. The fourth point is work with international financial institutions in order to increase the trust to the figures reported by the governments. Because it happens, unfortunately, that even the official state figures, government figures, do not reflect the actual situation. And that's a huge issue. The fifth and final point is, in order to provide long-term predictability to budget deficit and public debt, work with a fiscal rule. As this fiscal rule is something which Germany adopted, which the Eurozone adopted after the 2008-2009 crisis, and it is about what the governments can do and cannot do about fiscal policy, especially the fiscal rule is about the next governments coming. The fiscal rule should be counter-cyclical, which means save it during the good times and spend it during the bad times to counter-cycle the economic downs and ups. The fiscal rule should also provide flexibility for extraordinary times. For example, when the circumstances necessitate additional spending for disaster recovery or for immediate defense purposes, like the Europe is living through nowadays, the fiscal rule should allow additional spending during difficult times. And ladies and gentlemen, at this moment, I would like to stress one point. Elections, being elected, is at the very core of the democracy. Being elected gives the governments the political legitimacy that they depend on. But democracy is not just about elections. What makes democracy strong is rule of law, transparency, and accountability. Only by embracing these values and principles, elected leaders deliver good results for their citizens. The second subject in today's forum is the stability of the banks. When banks operate safely and soundly, they facilitate investment, support consumer confidence, and ensure credit flow even during times of uncertainty. If banks fail, consumers and businesses suffer. In case of deep crisis, like happened in Europe in 2008, sometimes citizens cannot even access to their deposits in the banks, which brings huge social disasters. Systemic risks are very important to monitor and act when necessary. And let's don't forget, the 2008 crisis was triggered by the banking system, which was not able to manage the risks associated with the mortgage market. It started in the US with the mortgage market, and it was widespread across the world. So the core of the crisis was the banking sector, but the countries which had high debts was affected in the most severe way. So strong internal controls and sound risk management practices are essential when we talk about the banking system, and implementation of regulatory frameworks such as Basel III is important. Banks must continuously update their risk assessments, stress test their portfolios, and ensure that management practices are in line with global best practices. Now, I'd like to drop just a few notes about Turkey, a country which I was the head of economy for 11 years. At the beginning of this century, after a series of financial crises, Turkey adopted strict fiscal policies aimed at reducing budget deficits and controlling public debts. We implemented measures to increase transparency in debt reporting, ensuring that all liabilities were clearly disclosed. The transparency does not only boost investor confidence, but also it sets the stage for sustainable debt management. The rigorous fiscal consolidation contributed to lowering Turkey's debt to GDP ratio, which was crucial for regaining access to the international capital markets. After 2003, public debt to GDP ratio in Turkey dropped from 74% to 27% in 10 years. Turkey actively extended maturities of public debt and significantly reduced the share of foreign currency debt. This eventually reduced short-term fiscal pressures. Resources freed up through these efforts were strategically redirected towards infrastructure, education, and healthcare, investments that directly contributed to the long-term growth and improved the quality of life. Yes, during those years, the government spending was under strict control, but the confidence that was built helped the private sector to increase spending and investments. Sometimes the rhetoric is the government should spend money so that the economy grows. Yes, government spending contributes to growth, but if too much spending hurts the confidence, then we are at the point where we start at the beginning. So it's not just government spending, but also about the private sector spending and investment which fuels growth. So if you create the environment of confidence by being prudent fiscally and by making sure that public debt sustainability is not an issue, it opens a huge space for private sector to do more business. And that's exactly what happened in Turkey. The government sector as a percentage of the economy was smaller and smaller, but the private sector as a percentage of the economy was larger and larger. So that is how Turkish economy reached record high figures even during the difficult times of 2008-2009 economic crisis. Another cornerstone of Turkey's success during 2003-2013 period was the overhaul of its banking system. We initiated a significant consolidation process, and this process was composed of mergers and closure of the banks. Yes, when the banks are weak, you have to do something. You cannot just watch them melt away. And this is exactly what we have done. So Turkish banks improved their capital buffers and adopted more rigorous risk management practices. After the banking reforms were completed, not a single bank in Turkey was affected during the 2008 global crisis. So the crisis that we have gone through in 2001 helped us to strengthen the fiscal situation, helped us to strengthen the banking system. So when the global crisis hit in 2008, 2009, our public finances were strong, our banks were strong, so we were not affected at all. To sum up,
please continue, Minister.
The combined effect of fiscal discipline, transparent debt management, and a reformed banking sector significantly improved Turkey's credit ratings. As investor confidence grew, Turkey was able to attract much needed direct investments and integrate with the global financial markets. So two key lessons: proactive reforms are essential, transparency and accountability build resilience. Finally, yes, the democracy is very, very valuable, but it is also very fragile. There has to be strong defenders of democracy. I hope that this forum, today and tomorrow, will open new horizons on how to strengthen democracy and how democracy can better deliver to the citizens. Of course, talking about democracy, human rights, freedoms, I am also deeply concerned about what's happening in Gaza, starting from this morning. I hope and wish the international community strongly stands up for an immediate ceasefire and finally a lasting peace for Palestine.
Thank you very much.
May I join my voice with my colleague from Ankara to call upon the West to end its complicity in the ongoing genocide. I think I appreciate that we can join forces across the Aegean with my Turkish friends to call for an end to events in Palestine that will stigmatize this generation through the rest of history.
To awkwardly circle back to the core idea of this morning, I do again apologize for having interrupted you in your opening speech, and I think we stopped you just before you were going to move on to talking about giving us a bit of an overview of your take on the importance of banking stability. So if you want to pick up there, and then perhaps we can have a bit of a back and forth with Minister Babakan once you've wrapped up there.
Look, the 2008 crisis was not caused by public debt. Public debt was the symptom. It wasn't the cause. It was caused by a degree of exuberance in the North Atlantic's banking system, United States, Germany, France, Europe, that essentially created such a gigantic bubble. It involved active criminality as well. It wasn't just immature risk-taking. And when the bubble burst, you could see that public debt was, as I said, not just a symptom, but a multifaceted symptom. So you had, take two countries, Greece and Ireland, both members of the Eurozone. Ireland had a debt to national income ratio of only 25%. well below the 60% maximum limit set by the Eurozone Maastricht Treaty, right? Greece, we were at 110%. Well, both countries went bankrupt. Why? Because it really doesn't matter that much whether the debt, the overblown debt, is public or private. In Greece, it was the case of very high public debt. In Ireland, it was very high private debt. In the end, when the bubble bursts, even if the public debt is very low, the state debt is very low, once the banks fall and the governments are forced by the bankers essentially to bail them out, then all the losses of the banks are transferred to the shoulders of the weakest of taxpayers. And then you have 20 years of stagnation, and Europe becomes essentially a deindustrializing economy. So I'll conclude saying this. There is very little that you can succeed through proper regulation because bankers always find ways of gaming the system. The most effective way of keeping the financial genie in the bottle is through the fear that the state must inspire in bankers that if they lose it, then they lose it. That is, that if their bank goes bankrupt on their watch, that they will be thrown out, which is what I mentioned that before. South Korea did in 1998, Sweden did in 1992. We didn't do it. When you bail out the bankers, effectively you are signaling to them, go crazy, make as much money from creating bubbles as you can, and when your bubbles burst, it is the weakest of the taxpayers that will bail you out. If you do that, then you can never talk about financial stability in any way that is remotely credible.
Is there no way to banker-proof the system without basically just letting them fear the fall? Is there no regulatory or framework way that you can make sure that when the X hits the fan, that bankers do not still have this sway over governments in terms of who they prioritize in where they send the money?
Well, you can restrain their exorbitant power. For instance, instead of these, the current rules, which are based on what's called the capitalization ratio. So regulators, especially after Basel III, and 2 and 3, they've tried to essentially force them to keep more money on their books in case for a rainy day. But they've done that by saying to them that, look, you are going to have a minimum amount, a minimum ratio of your own money. That's what goes on the numerator of the ratio. But the denominator is your risk-weighted assets. Essentially, what you're telling them is you can manipulate the numerator by giving it different amounts of riskiness. So, and they can game the system. If you wanted to be tighter in the way you regulate them, you would have to give them a minimum equity ratio. That is to say to them, we don't care whether you think that Greek government bonds are safe versus McDonald's bonds. What we expect you to have is a certain amount of equity, which is compared to the total size of your loan book. That will restrain them, but in the final analysis, we know that you constrain them here, they pop out somewhere else. You have the shadow banking system. You have the private equity that outfits that find ways of collaborating with bankers and creating risks in different parts of the system. So the system will, however beautifully designed your regulatory system is, at some point it will create financial crisis. What really matters is when the financial crisis hits, that you do save the actual machinery of the banking system, because it's like the arteries and the vessels of the body, of the economy, but not the bankers. So they have to be constantly fearful of what will happen if their shenanigans blow up. They need to know that they will go bankrupt. The tragedy of the Obama administration and the Eurozone administration after 2008, 2009 is, as I said, they printed $35,000 billion between 2009 and 2022. and they passed it on to the bankers that had blown up the banking system in 2008. This is exactly what you do when you don't care about financial stability.
When you're talking about setting up healthy boundaries, as it is, what is your take on how international lenders should approach countries trying to respond to crises? You know, should they? We were talking earlier about you've mentioned your take on austerity, but that in itself, is that not some pretty strict boundaries as to the conditions under which they're going to be given a bailout or be given money? Are we not talking about the same thing that you are evoking with your recommendations for restraints on the banking sector?
Well, let's take the International Monetary Fund, which is the main multilateral organization that steps in moments of crisis. If you utter the acronym IMF in South Korea, you're going to be met with very aggressive looks on people's faces because they've had such a terrible experience with the IMF in 1998. Remember, the IMF was the organization which, before 1998, was pushing countries like South Korea, the whole of the Southeast Asian tigers, to tether their currencies on the United States dollar, on the basis that it will create more certainty and more financial stability. That was a huge error. That created a flood of dollars being lent to Thailand, to South Korea. That created bubbles. And then when that gross error of the IMF was revealed, what does the IMF do? Doesn't apologize, goes back to Seoul and says, okay, we will lend you the money to preserve your peg with a dollar, right? Which essentially was a very short-term strategy for allowing the foreign investors who had come into Korea to convert their money back into dollars, which the IMF had lent, so that foreign capital can, flee out of South Korea, leaving nothing but devastation behind, and then allow a huge devaluation to do the damage that it did on the social fabric. In the case of Greece, when I was negotiating with the IMF, we had exactly the same situation. The IMF had supported the policies that had created the bubbles, which then burst, and then the IMF came and imposed gigantic austerity, 40% cuts in pensions, in the lowest of the pensions, very brutal and very cruel, and lending money so that the bankers could be bailed out in a manner which was not even sustainable, because in the end, all this money that was lent on top of the losses of the Greek state, of the banking system and so on, simply added to the public debt of Greece. And of course, you have the good people in Washington, D.C., who work at the IMF, at some point saying, yeah, we made a mistake. But that mistake, even being acknowledged so half-heartedly, essentially cost lives, as our host said in the program. And essentially it was also a solvent for democracy. Because when governments are elected, which, however, on the day of their election, either our government 2015 or the Sri Lankan government today, which is also in a very similar process of negotiating with the IMF, the failed bailout. Argentina, same story. The IMF irresponsibly lent huge quantities of money to previous Argentinian governments, money that was used by malevolent interests to essentially convert assets in Argentina into dollars, take the dollars out, and leave devastation behind. So the same technocrats who have been advising governments to do the things that brought about a debt crisis were the ones who, threw good money after bad, creating even more discontent, and therefore, adding to the dynamic where the politics becomes impossible to generate the kind of government that you need once the crisis is hit.
Do you have an example of an international lender interceding in a way that has actually, from your perspective, efficiently improved the prospects of the beneficiary of the loan or of its collaboration?
The only case I know, which wasn't a disaster, was Poland after the collapse of communism. Because the Polish government in 1993, 1994 was facing a debt crisis, like Russia was, like all the Eastern European countries. And the IMF arrived in Warsaw with its usual template, as it did in Greece, in Sri Lanka, in various places in Africa and Asia. And the Polish government at the time, to its great credit, said no. And they put forward their own adjustment mechanism, policy framework. And for some interesting geopolitical reason that probably had to do with the United States government thinking of Poland as too important to alienate, the IMF relented and went along with the Polish government's fiscal consolidation plan. And it worked brilliantly.
So just to be clear, so basically Poland came up with its own plan, presented it to the IMF, was like, look, we'll work with you on those terms.
Yes.
And it worked.
And the IMF relented and contributed. Because the other thing is, we must not universalize and generalize. So from my experience with the IMF, there are some really very good people in the IMF. So you have the staff of economists, of technocrats. Some of them are excellent. They have expertise. They even have compassion. If you look at some of the papers that have come out of the IMF staff, they are, very progressive. And then you have the leadership. The leadership is very heavily skewed towards the Europeans, and of course the Americans. The rest of the world, countries like China, like India, they are highly disproportionately represented. And watching the decision-making process at the IMF's board of directors is like watching sausages being made. You don't want to eat them afterwards.
How do you think, if that's being the historical case, how do you think that the personality of international lenders is going to be affected by some of the developments that we're seeing in Washington today?
Well, to begin with, I think that the world, as we all know, is fragmenting into two large sub-global economies. One is still attached to the United States and the United States dollar, and the other is, of course, attached to China. It's quite interesting that it's not just that you have these two dominant poles when it comes to finance, when it comes to technology. We have two big techs. We have Silicon Valley and we have China. And we have two payment systems now that are increasingly competing against one another. The BRICS blockchain system for making payments that do not involve the US dollar. This is a clear and present danger for the exorbitant privilege of the dollar. So the IMF, the International Monetary Fund, and the World Bank, the two remaining Bretton Woods institutions, are wholly located now in the dollar sphere, and they are very anxious that maybe they are becoming irrelevant as the BRICS are rising, and Trump clearly doesn't think much of international multilateral organizations like the IMF, like the World Bank. He wants to conduct his negotiations directly with Beijing. And therefore, these two institutions are experiencing an existentialist crisis. They were, let us not forget, they were created in the Bretton Woods Conference in 1944 to serve a wholly different purpose to the one they've been serving since 1971. So they've already undergone one major transformation. The therapeutic role that they played in the 50s and 60s gave rise to a toxic role in the 1970s. Effectively, they were like the bailiffs of the international bankers, of the American bankers, and less so of the European bankers. And this is why they're so despised in South Korea, in Pakistan, Bangladesh, in Greece, and so Ireland, for that matter. So now, either they will have to reinvent themselves in this bipolar world, or they will increasingly fade.
I think the thrust of this whole conference is about imagining what could be as wildly as we can.
Yeah.
We've heard a lot of sketching of why and what doesn't work. What should happen, according to you?
Well, I wasn't expecting this question, but I'm going to answer it gladly. Let's allow our imagination to run wild for a moment. But as per usual, to run wildly into the future, we have to go to the past. And I will go back to that Bretton Woods conference because certain Mr. John Maynard Keynes happened to be at that conference. And I think much of the answer to your question, he already answered it in that Bretton Woods conference when he put forward his proposal as to how the world should work, how the global financial system should operate. And the thing that John Maynard Keynes pointed out in his speech at the Bretton Woods conference, which was received with a great deal of appreciation, but was totally rejected by the United States Representative Harry Dexter White, who was a Keynesian, by the way, but rejected everything that his mentor said. It's an interesting story. It should be a movie. It should be a movie. Okay, so Keynes' main point is this. We have to stop thinking in terms of equilibrium. Nothing is in equilibrium when it comes to the economy. The solar system is in equilibrium, thankfully. Otherwise, we would be spinning out of control. But Germany will always have a trade surplus vis-à-vis Greece, vis-à-vis France, right? France will always have a trade surplus vis-à-vis Morocco. California will always have a trade surplus vis-à-vis Arizona. So there are these permanent imbalances which have to do with capital intensity, the relative degree of industrialization. It doesn't matter why, right? When you have these imbalances, you have to accept the fact that sustainability has to take into account that these imbalances need to lead to recycling. Let me put it this way. Imagine that, take two countries like Germany and Greece, completely at random. No, not so. If they're going to have the same currency, as we do, we have had one since 2001, then with every Volkswagen that is sold from Germany to Greece, 30,000 euros goes to a Frankfurt bank. If you continue doing this, you're going to have banks in Frankfurt that have too much money, and they don't know what to do with it because the Germans don't want to borrow all this money. So they will have effectively to find somebody who really needs that money and is prepared to pay high interest rates. So they lend it to the Greeks. So that perpetuates its vendor financing, right? That builds up debt in Greece and surpluses in. So it's not going to end well. The bubble will burst in Greece, and then Volkswagen won't get his money back, and then you're going to have troikas, and then you have political paralysis and disaster. Keynes was saying all this, not vis-à-vis Greece and Germany, but in 1944. So if we're going to have a system, a financial system, without banks procuring this debt dynamic that leads to bubbles that then burst and leads to tragedy, then we need to find a way of stabilizing it, of countering those imbalances. So his proposal was this. Imagine, he said, that we had something called an international monetary fund. That was his idea in that conference, right? Of course, the IMF we have now is nothing like the one he envisaged. So imagine we create an international monetary fund which operates something like a central bank for the world. And it has a common accounting unit, not a common currency. You will still have pounds in Britain, euros in the Eurozone, and dollars in the United States and so on. But we would have a fictitious world currency. He called it the banker. we could call it the cosmos. Doesn't matter. Call it something. Right? I prefer to call it the cosmos. Banker doesn't sound good. Okay, the K. Cosmos spelled in the Greek way. And you denominate all trade in Ks. Right? So when a Volkswagen goes from Germany to, let's say, Portugal, or from Germany to India, or a lump of aluminium goes from China to the United States, you put in the ledger, in the world ledger, in case that transaction as an asset for the seller and a liability for the buyer. Okay? And at the end of the week, of the month, the year, it doesn't matter, after a certain period of time, you calculate every country's trade deficit or surplus. And then you apply a levy symmetrically on both those who have deficits and those who have surpluses. So you don't punish the deficit country, you punish both the deficit and the surplus country. And the argument of Keynes was that, for every debtor there is a lender, and for every surplus producer there is a deficit creator, right? So I can't possibly celebrate the fact that I am selling more to you than I'm buying from you, that I have a surplus, while admonishing you for being in deficit. It makes no sense. So, and those levies are charged in this IMF, and they go into an account. And his idea back then in 1944 was that this money, which is collected from all the countries in proportion to their imbalances, trade imbalances, this money then is given to something, he said, that we could call it the World Bank. Okay, that was his idea too, which then invests it in the poorer and most deficit-stricken parts of the world to create the productive capacity in the deficit countries that will allow them to generate the incomes so that they are no longer in deficit. And today this could be a climate fund, for instance.
So let me get this. So basically, it's accepting that imbalance is always going to exist, monetizing those imbalances, and making sure...
restraining them through applying levies on them, penalizing them and restraining them. And they generate...
Maybe more like leveraging the monetization of those imbalances to both act as a restraint and also generate income to invest in creating greater good for more people.
In the poorer countries.
Yeah.
To lift them up, because it is in the interest of the richer countries that the poorer countries are lifted up. That's what Keynes proposed in 1944. Today, with all our algorithms, back then he was thinking of accountants with pen and paper and all that. Today, it's ever so easy to create that system.
Can't you just adjust the
digitally
rules regarding SDRs to do something like that?
Well, Georgia, you're spot on, because the SDR was developed in response to his idea of the banker, which I call the cosmos. The SDR is that, but they never went as far as to implement the system, because it's not enough to create the accounting unit, which they call SDRs, special drawing rights of the IMF. They never denominated trade in them, and they never applied the levies, and they never collected the money to invest in the poorer, more deficit-prone countries. So it was only a kind of window dressing to create the SDRs. It was only for the purposes of internal IMF accounting, which didn't have a positive impact on the world.
But I mean, SDRs are currently such a big focus from not just the global south, in terms of a currently existing mechanism,
which is not used,
which adapted could make a massive difference in the way things are done.
Keynes told us how to adopt it, and today we could really do this. And you know what? Allow me a prediction here. I try not to predict, but I think this is a relatively safe prediction. Lots of people are talking about China and the BRICS creating their own currency. I don't think Beijing wants that, and it doesn't want that because they have $3.5 trillion worth of savings in dollars. So the greatest supporter of the dollar system is Beijing, because you don't want to undermine the bank in which you hold your savings, right? But if this new Cold War that Trump 1.0 unleashed in 2017 escalates once hopefully the Ukraine war is settled, finished, then there might come a moment when Beijing doesn't issue an alternative currency to the dollar, but creates something like what Keynes proposed at the IMF, at the Bretton Woods Conference in 1944. Beijing would, instead of creating its own dollar alternative, might turn the BRICS into a kind of Bretton Woods along the lines of Keynes's program.
And what do you think that would do to the international kind of economic landscape?
Well, it would create a serious challenge to the reserve status of the dollar. The United States would react violently, because the only reason why the United States remains hegemonic is the exorbitant privilege of the dollar. Its manufacturing now is 45% of the China's manufacturing. And the answer to your question in the end will be determined solely by politics, not by economics.
By politics by bloc or politics by nation? Well, what I mean by that
is... by politics in the United States primarily.
Right, okay.
Yeah? Who's going to have the upper hand? The hawks that want to unleash, their military hegemony in order to preserve the hegemony of the dollar? Or is there going to be some administration that will contemplate the extension of this Bretton Woods Keynes-like system to include the West as well as the East?
There was one issue that I really wanted to raise whilst we have each other, which is how the increased militarization of Europe in particular, or at least that the recognition that is something that they're aspiring to, is going to affect all of the things that we're looking at the moment: banking stability, national budgets, and even the prospect of imminent economic crises.
Yeah, well, it's very interesting that today, 300 meters away from here, at the Bundestag, at the federal parliament of the Federal Republic of Germany, this parliament, this outgoing parliament, is going to confine to the dustbin of history the Austerian debt brake that has ruled Germany's finances for the last 30 years. Thank goodness, it was about time. Unfortunately, the military Keynesianism, which they are going to replace it with, this idea that the sky's the limit and we're now going to spend as much money as necessary, up to even more than 1 trillion euros on defense, on bombs, guns, and whatever. Also expanding the personnel of the Bundeswehr, the German army. That is presented by the new coalition government, most of the establishment press here in Germany, as Germany's return. That Germany has managed to rid itself of the Austerian constraints, and now there's going to be a reindustrialization based on this kind of military Keynesianism. I very much fear that in the same way that the debt brake, which they are getting rid of, was fiscally responsible in the end, the way in which they're getting rid of it is also fiscally responsible, because the German and the European decision makers have to understand that 15 years of zero investment as a result of austerity has left Europe behind China and the United States technologically. We've missed a technological revolution. So what are the sectors that would ensure development, a dynamism for Germany, for Europe? Green energy. We're not capable of competing with the Chinese on this, or with the Americans. What I call cloud capital, digital algorithmic capital, gone. This is big tech in Silicon Valley and big tech in Shenzhen and Shanghai. We have zero investment in this continent. social care, and anyway, all those things that would make Germany great again. Yeah, I know. Sorry.
So
You know, I'm toying with your nerves. They are not going to be invested into when we buy tanks from Rheinmetall. And tanks from Rheinmetall do not allow for a Keynesian multiplier accelerator dynamic. So we're going to essentially take Germany's debt to GDP ratio from 60 to 85 or 90% without doing anything about bank stabilization, financial stabilization, inequality, which is fueling xenophobia, racism, the AfD, populism, without doing anything about the fact that we are no longer capable of competing with the Chinese and the Americans when it comes to these technologies of the future.
Yeah,
so I very much fear that, you know, this conversion of the Austerian German establishment or European establishment to a military Keynesian establishment would be anathema amongst all, above all, to John Maynard Keynes.
Yanis, thank you so much
Thank
for, you know, for